Hello and welcome back to London. The markets have reacted bearishly to Big Ben Bernanke's announcement, but what does this mean for the FX rates? Well, I've been catching up with Miles Eakers from Savi Trading to get his views. Okay, Miles, I don't want to get into the morality of what Ben Bernanke's done and whether the US economy is showing enough signs to unwind QE. I just want to talk about the market implications. The announcement from the Fed is surely going to bring some welcome volatility from a trading point of view.
Yeah, definitely. We've been eyeing overbought signals on euro and cable for a while. We've been selling rallies up to 134 on euro. We had a level at 134.35. If we reached there, we'd be selling up there as well. So we've been short. We sold more last night on the back of the Fed statement. The implications aren't on tapering, but they're starting to see signs of growth, like less negative indications in the market, which for us is a signal. The next few months are going to start seeing some maybe $5–10 billion reductions in tapering, and a lot of people are saying it's not tightening, but for us it is the first signal of potential growth now in the US, which is very good for the dollar.
In terms of your trading style, you talk about the signals for overbought and oversold. What technical models are you using? Is it just your own proprietary models?
Yeah, so in-house algos basically that we've built over the years of experience that we've used. They often can give signals a bit too soon, so we are patient and vigilant that often you get these signals building up to a market event, and it's often important to wait for the actual event rather than going in beforehand.
So where's the money going to go? Because we've seen a sell-off across markets really, even in gold and silver and equities. So where is the money going?
US Treasuries, I think, is the ideal. Yields are starting to push up, and I think that's the trend that's going to be apparent. You're seeing a massive move down in emerging markets, like Nikkei is obviously doing well on the back of dollar-yen strength. So you're seeing a general shift away from these BRIC economies of export-driven, commodity-based models to now the US is the major player in the market.
So where are you ideally, which pairs are you seeing the biggest profit opportunities?
We like short Aussie dollar. We've broken through key weekly support. We wouldn't be selling down here, but any sort of rallies offer great opportunities to get short, targeting the 80 area on the downside. We think CAD's got some further downside, so bullish on dollar CAD. Although if the US economy does start to grow, we could see some CAD strength across the board against maybe the Aussie. European data is going to have to start improving if we are going to see any euro strength. But we've got the German elections coming up, which could be a nice risk-off event as such.
And what about the dollar-yen? Because what does the announcement by the Fed mean for that particular pair? Or is it just a case for the dollar-yen just waiting for those Japanese elections that are coming up?
Yeah, I think that's obviously going to be a key catalyst. I think the obvious trade is long dollar-yen. You've got dovish monetary policy from the Bank of Japan and hawkish monetary policy now from the US Fed. Clear indication that dollar yen is likely to go up. We saw a squeeze, we were waiting for that squeeze. We thought everyone had got short the yen, and invariably when the whole market gets into a trade, it gets squeezed out. We now see our further upside back up to the 100 area, and we could see that as a key pivot point in the weeks to come.
Do you think that 100 level can be broken? Is that feasible?
Potentially. We think it will offer some selling interest to start off with. There's some technical shapes forming that could indicate that could be a new barrier. Again, with market participants seeing that as a good area to get short.
Well, Miles Eakers from Savi Trading, always good value for some trading ideas. But unfortunately, that's all we have time for right now for this edition of London Direct. So for now, goodbye.